Let's take a trip back in time. The year is 1979. Inflation is absolutely out of control. The economy feels stuck in the mud, and any money you have in savings, well, it's losing value by the day. It was a deeply uncertain time. So the big question was, how on earth do you invest in a world like that?
I mean, that was the question on everybody's mind. It really felt like you were playing some kind of financial game where the rules were always changing and the scoreboard was just melting. Every single dollar you made was worth less tomorrow than it was today. It's a tough game to win.
And right in the middle of all that chaos, Warren Buffett sits down to write a letter. Not just any letter, but his annual letter to the shareholders of Berkshire Hathaway. And he wasn't just, reporting the year's results. He was laying out a clear, timeless philosophy for how to navigate exactly this kind of economic storm. Okay, let's dive into this incredible letter. So first things first, Buffett knew he had to correct a huge mistake that almost everyone was making. He basically argued that Wall Street, the whole investing world, was using the wrong map to figure out if a business was any good. They were all looking at a number that could be, well, dangerously misleading.
See, on one side, you've got the Wall Street scorecard, and it was all about one thing, earnings per share, or EPS. That was the number they obsessed over, the one they needed to see go up every single quarter. But Buffett said, hold on, that's just an illusion. The reality, the true test of how well a manager is doing their job, is return on equity. How much profit are you actually making with the money the owners have invested in the business? That's the real score.
And Buffett, of course, had this perfect, witty way of putting it. He said, even a stopped clock can look like a growth stock. What did he mean by that? Well, a company can pump up its earnings per share just by keeping its profits and reinvesting them, even if it's getting a pretty mediocre return. It gives you the appearance of growth, but it's not creating real underlying value. The lesson is crystal clear. Don't get fooled by a slick-looking EPS number. You have to look under the hood.
But here's the thing. Even if a company passed Buffett's test, even if it had a fantastic return on equity, he warned that there was this silent killer lurking in the background, something that could wipe out all those hard-earned gains.
He gave it a name, the Investor's Misery Index. And it's a simple but absolutely devastating formula. You just take the rate of inflation and you add the taxes you have to pay on any of your investment gains. Now, if that combined number, the misery index, is higher than the return the business is earning, well, you're actually getting poorer. Your account statement might say you're making money, but your real purchasing power, what you can actually buy with that money, is shrinking.
And he brought this idea home with just a stunning example from his own company. Get this. For 15 straight years, Berkshire compounded its book value at over 20% a year. I mean, that's a spectacular result by any standard. And yet, after all that incredible work, the company's value had only kept pace with a half ounce of gold. It was such a sobering lesson. Those paper profits, they don't mean a thing if they just get eaten alive by inflation and taxes.
Buffett's next big lesson. Well, this one came from a very personal place. A mistake. A big one. And it's a powerful warning about how tempting and how dangerous it is to buy something just because it looks like a bargain.
So a few years earlier, Buffett had bought a struggling textile business up in New England called Wambeck Mills. And on paper, it looked like an absolute steal. He bought it for way less than the value of its working capital. He pretty much got the buildings and all the machinery for free. I mean, what could go wrong, right? Well, as Buffett admitted with his classic honesty, just about everything went wrong. He wrote that even though the price was an extraordinary bargain by any statistical test, the purchase was, flat out, a mistake. Why? Because the business itself was just awful. He said it was like a sinking ship. As soon as they'd fix one leak, another one would spring open. It was a constant fight just to keep its head above water. And the numbers from 1979 tell the whole story. Berkshire's textile operations barely made any money, less than $1 million. Meanwhile, its investments? They brought in over $20 million. This contrast couldn't be more stark. It showed exactly where the real value was being created. The textile business was just this constant drain on his time, his energy, and his capital. And that whole painful experience with Wambeck Mills led Buffett to one of his most important and, frankly, most famous conclusions about investing. And it's a principle you've probably heard. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. He realized that your time and your energy, they're finite. It's so much better to spend them working with a great business than to waste them trying to fix a broken one, no matter how cheap it seems at the outset. So the final piece of this puzzle isn't about what to buy, it's about who you want along for the ride. Buffett had this really unique philosophy about the kind of people he wanted as shareholders in Berkshire Hathaway.
He used this amazing analogy from another legendary investor, Phil Fisher, who compared a company to a restaurant. Think about it. A restaurant has to decide what's on the menu. You can't be serving fancy French cuisine one day and then switch to takeout chicken the next without totally confusing and upsetting your customers. Eventually, you'll have a revolving door, and no one will stick around.
Buffett took that idea and applied it directly to Berkshire. He had zero interest in attracting short-term speculators, people who would just trade the stock on a whim. He was serving a consistent menu, a laser focus on long-term intrinsic value. And his goal was to attract a stable base of shareholders who understood his approach and were on board with it. He wanted partners, not day trippers.
And did it work? Oh yeah, the proof was right there in the letter. Buffett revealed this mind-blowing statistic. 98% of the people who owned Berkshire stock at the start of the year still owned it at the end. A 98% retention rate. That was basically unheard of. Buffett's restaurant had found its loyal customers, and they weren't going anywhere.
So when you take this entire letter from all the way back in 1979 and you boil it down to its essence, what do you really get? You get a playbook that is just as powerful today as it was during the inflationary storm of the late 70s.
Let's just quickly recap it. 1. Measure what actually matters. That's return on equity, not the illusion of earnings per share. 2. Understand and have a healthy fear of the real cost of inflation and taxes. 3. Put your energy into buying wonderful businesses, even if you have to pay a fair price, and stop trying to fix bad ones just because they're cheap. And finally, number 4, treat your shareholders like partners who are in it with you for the long haul.
And that really leaves us with a final thought, doesn't it? In our modern world, which is just filled with high-speed trading, crypto, meme stocks, and constant noise, does this patient, business-first philosophy from 1979 seem a little outdated? Or is it possible that in an environment with more distractions and uncertainty than ever before, this advice has never been more valuable?